Hello everyone, welcome back to the show. I'm about to dive deep into what has turned out to be one of the wildest years in recent financial history. Today, we're going to dissect the wild speculative retail frenzy, relentless AI disruptions, and the crypto roller coaster, all in the context of this catastrophic economic environment shaped by uncertain policies, disastrous government meddling, and twisted financial strategies. Let's break down what went wrong, who's to blame, and, surprise, surprise, why we might just be headed towards something much worse. Buckle up because it's been a year packed with mind-boggling volatility, reckless investments, and, well, what I like to call, government-induced financial suicide, unraveling the shocking forces balancing on the thin line between economic collapse and speculative euphoria. If you're one of those folks who have followed the 2024 markets, you already guessed it, pure madness. There seem to be riches just waiting for the taking, from ambitious leveraged traders to up-and-coming hedge funds looking to squeeze out a profit, or a few million. August gave us a vivid view of why reckless speculation tied to unclear market signals can sink an entire market. Traders toyed with new quick money tactics, not realizing that something key was being overlooked. Market fundamentals became an afterthought. But was this surprising given the state of economic policy? Of course not. Especially when the big players on Wall Street, emboldened by political turbulence and ongoing mismanagement of economic policies, made their big moves. Let's not beat around the bush here. Wall Street's big gamble with Donald Trump. A payoff like that left many wondering if this was economics or high-stakes gambling. Hedge funds deploying complex mechanisms took hits, while simpler strategies, like parking funds in tech stocks or good old cash, led to fewer headaches and a smoother game. Let's talk about the retail mob. Retail investors, once novices riding the 2021 post-pandemic rally, now attempted to surf the chaotic waves of speculative investments in 2024. A classic story, rushing into meme stocks and speculative tech ETFs only to exit, hastily, when their gains seemed dodgy. Can anyone blame them for panic selling assets like Nvidia and Tesla at the lows in August? It's tough to watch your hyped stocks tank, only for them to double down when you've already cut your losses. The lesson here, though, is a painful one: bad timing can turn speculative geniuses into repeat losers. When the Trump wave sent financial stocks close to the top. Too late. Mom-and-pop traders had bailed. At the end of the day, retail investors finished 2024 with a measly 9.8% gain, the second weakest performance year since 2015 in a market with net positive returns. If you were betting on AI in 2024, you probably felt like a genius throughout the year. Technology stocks, dominantly tied to artificial intelligence, skyrocketed with help from ETFs, more elaborate trading products, and expanding investor interest. Now, let me be clear. Traders poured over $6.5 billion into single-stock ETFs tracking favorites like Nvidia, which saw its strategy, NVDL, explode by 350%. Yeah, those kinds of returns steal headlines and attract short-term investors looking for a quick buck. At face value, this sounds like a tech utopia. But what's lurking underneath? The broader consequence of these concentrated bets, a growing fragility in the market powered by excitement, not value. Did AI change the way companies do business? Absolutely. But did AI innovation reach a point where Nvidia's stock tripling in value was backed by true productivity? That's debatable. The truth is, AI is seeding a speculative future where prices reflect more hype than technological contribution to productivity or long-term economic health. Congratulations to millions who profited in 2024, but AI may well be laying a foundation for bubbles waiting to burst. 2024, the rise, and rise, and rise, of crypto. If this was truly Bitcoin's moment to shine, what a comeback it has been. 2023 ended with Bitcoin touching highs and then breaking past $100,000 early in 2024. That was it, as if Bitcoin itself shouted, no more doubts. But we have to recognize the factors behind it, especially when the approval of US Bitcoin ETFs turbocharged the market beyond traditional finance's wildest expectations. Investors poured billions into these funds, and suddenly, crypto was no longer fringe. It became the center of financial media's attention. We have Trump's November victory to thank for intensifying this so-called crypto spring. He essentially transformed from a vocal Bitcoin skeptic to a strong advocate of decentralized finance in no time. The US Bitcoin ETFs garnered $100 billion, driving value and triggering mind-blowing volatility in memecoins and other riskier crypto assets. Moreover, Trump wasted no time replacing the notoriously anti-crypto SEC chief Gary Gensler, quickly installing Paul Atkins, giving greater breathing room to the industry. America seemed to transition overnight from anti-crypto to pro-crypto regime in response to Trump's promises to make the US the digital asset innovation hub of the world. But here's a word of caution: while digital assets continue to surge, don't lose sight of underlying realities. This meteoric rise is far from based solely on utility and productive financial innovation. Yes, there was lucrative speculation. However, the regulatory easing smashed open the doors for concentrated risk in ways traditional institutions had barely prepared for. How sustainable is this wild crypto buy-up? Traditional financial investors, and let's be honest, anyone old enough to remember dot-com crashes, probably didn't miss the eerie similarities between this new explosion and those infamous bubbles of prior decades. Even Michael Saylor from MicroStrategy, who's been endlessly accumulating Bitcoin through stock sales and bond offerings, can gloat, at least for now. Sure, MicroStrategy's stock has surged fivefold in 2024, Bitcoin's resurgence vindicated his obsession, which many saw as borderline insane. But again, how long before the speculative frenzy blows the fuse? The backdrop to these chaotic markets? U.S. politics, particularly the unpredictable outcomes and invisible lines drawn by Biden's administration, followed by Trump's sweeping political comeback. The 2024 regime shift is not just fodder for headlines, it lays out real threats to economic stability. A once sharp regulatory push under Biden fizzled out under Trump's market-friendly platform. We witnessed how Trump's return to office pushed masses of retail and institutional investors alike to double down on risky opportunities like crypto, hedging the bets of traditional markets. Yet, the big gamble behind Trump's policies, lower taxes, deregulations for the crypto market, and increasing tariffs, has incredible potential to distort an already fragile economic reality. Pro-growth initiatives sound good on paper, right? But these steps, without solid economic planning, could easily push inflation high while adding to global market uncertainty. On the other side of the world, we see a stunning case as Argentina's political economic experiment under Javier Milei unfolds. Milei, the fringe, combative libertarian, threw traditional fiscal policy out of the window. Aiming to dollarize Argentina's economy and abolish their central bank, Milei's shock therapy startled the world. Yet, a year into his term, somehow, the early indicators seem to support a positive trend. Argentina's economy buckled under triple-digit inflation in 2023, but now investors see hope under Milei's heavy-handed reforms, despite many early concerns. His reforms slashed government spending and shifted responsibility squares onto the shoulders of businesses. According to Bloomberg data, Argentina has seen 104% debt surges, placing Milei's reforms among the region's best comeback stories this year. Again, though, we must ask, is this sustainable? Sure, firms like Neuberger Berman and Lazard Asset Management bought into Milei's revolution early and reaped significant returns, but long-term risks are flying under the radar. Investors need to think critically, how long before these turbulent reforms hurt instead of help? Argentina remains under deep pressure from international bodies like the IMF, while foreign investments still lag. So, what's the takeaway from 2024's economic chaos? We have a landscape marked by irrational bubbles, rampant speculation, political gambling, euphoria, and a crypto-fueled economy teetering on catastrophe. Many of the bad investments are products of sheer manipulation in policy coupled with blind speculative faith from retail investors, blindly following trends often hyped by media narratives. It's easy for day traders to cheer the market's volatility, pouring record amounts into leveraged ETFs and glorified cryptocurrency hype. But at the end of the day, they are playing a game that's aggressively rigged against sustainable return. 2024 was a year when gains came without deep insights into fundamentals, and now we stand at the precipice of major fallouts to come. The economy is simmering beneath surface-level exuberance. The investors who cashed out early will celebrate today, but what's coming next could very well shake those who failed to prepare. Wrapping up this review, you know what? It's never been more crucial to recognize the crucial need for individuals and governments to engage in responsible economic stewardship. Otherwise, the collapse that's brewing might not just be another blip on a graph. It'll be the consequence of widespread hubris, unchecked by realistic market fundamentals or prudent political strategies. That's all for today. Stay wise, stay prepared, and don't be fooled by the temporary highs. The real economic reckoning, well, it could be just around the corner.